If the housing market keeps falling like this, many people's financial situations are likely to collapse. Have you noticed something terrifying happening in Nanjing? 3 years ago, many people took out business loans, renovation loans, and credit cards to get on board, and the mortgages for buying houses are about to mature one after the other. However, due to the decline in housing prices and the overall economic environment, it's very likely that incomes won't keep up. It will lead to a large number of people defaulting on their loans. If the housing prices continue to drop like this and the market remains slow, it's feared that in the second half of the year, there will be a high possibility of many houses in Nanjing being auctioned off at discounts of 30%, 40%, or even 50%. Can you believe it?
I strongly urge immediate market intervention. Why? In Shenzhen, many high-quality properties from the central and western regions have seen their prices plummet to levels seen 6 years ago, with declines of around 40 to 50%. If we allow property prices to continue falling, and suppose they drop another 20 to 30%, the consequences are unimaginable. This would mean that in first-tier cities, over 95% of the middle class would see their assets wiped out overnight, turning all their net assets into liabilities. Many people's hard-earned accumulations and efforts over 10, 20, or even more years would be reduced to nothing. In recent years, China's real estate market has been in a slump, with housing prices continuously declining. Against this backdrop, real estate investment remains low, leading to a reduction in demand for Chinese steel and resulting in excess steel production capacity. According to the Financial Times, following the widespread outbreak of the pandemic, the recovery of China's domestic consumption market has fallen below expectations. This has led to overcapacity in industries such as steel, automobiles, and solar panels. Industry experts believe that China's real estate market continues to decline. They also observe intense competition in the Chinese steel industry, worsened by internal rivalry. Consequently, the Chinese Communist Party, CCP, is exporting significant amounts of steel to reduce domestic overcapacity. Data from the Chinese General Administration of Customs shows that from January to February this year, China exported 15,910,000 tons of steel. That's a year-on-year increase of 32.6% and is the highest amount for the same period in 8 years. The average export price was $791.70 per ton, which is a 32% decrease compared to the same period last year. The steel market is often seen as a barometer of the Chinese economy. The last time China engaged in large-scale steel dumping was during the severe economic downturn from 2015 to 2016. Asia editor at business media company Collinish Commodities, Thomas Gutierrez, noted that following the conclusion of the CCP's 2 sessions, Chinese steel companies began significantly reducing prices in export contracts. Gutierrez stated that they originally expected steel exports to decrease this year if the real estate market could stabilize. However, due to the ongoing decline in the real estate market, an increase in exports seems inevitable. Assistant Director and Economist at Moody's Analytics, Harry Murphy Cruz, found that the bleak outlook for the Chinese market also reflects iron ore prices. He pointed out that due to the lack of effective economic stimulus measures during the CCP's 2 sessions, this year's construction plans have been affected. It has led to iron ore prices dropping to their lowest level since August 2023, just above $100 per ton. Senior commodity analyst at ANZ Banking Group, Daniel Hines, stated that apart from weak domestic demand in China, it is expected that developed countries will implement more lenient monetary policies later this year. This will provide external motivation for China's steel exports. Colin Hamilton, commodity analyst at BMO Capitals in London, pointed out that the CCP is shipping steel to overseas infrastructure projects in developing countries. For example, the Belt and Road Initiative funded and constructed by China. Hamilton stated that unlike past exports driven by economic considerations, this round of exports is more geopolitically and strategically oriented. Analysts also note that compared to 2016, Western producers are now better protected and less by CCP dumping. This is mainly due to tariffs and other trade barriers imposed by these countries on Chinese exports, as well as subsidies for green steel. However, analysts remain concerned that Chinese steel products, including hot-rolled coils, are being exported to Europe via Asian countries like India, Japan, and Vietnam. This potentially has an impact on the international steel industry. According to Chinese media reports, on March 27th, Saudi Aramco holds a significant position in the global energy market. Also, Chinese steel companies provide critical materials to them. They supplied materials including the X70M advanced pipeline from Shandong Iron and Steel Group, X60MO from Shagang Group, and X52MS from HBIS. Also included are various products from Bao Steel, Nanjing Iron and Steel, and Wuhan Iron and Steel Corporation. Reports indicate that in December 2023, Shandong Iron and Steel Group shipped 15,000 tons of X70M advanced pipeline to Saudi Aramco. In September 2023, Shagang Group sent 46,000 tons of X60MO advanced pipeline steel. In May 2022, HBIS exported 5,000 tons of X52MS high-end steel pipeline to Saudi Aramco. In March 2022, Bao Steel collaborated with Saudi Arabia's local pipe manufacturer AQPCK to secure a large supply contract of 62,200 tons of X70 thick plate pipeline steel for Saudi Arabia's Jafurah gas field. Previously, data from China's General Administration of Customs on January 12 showed that in 2023, China exported a total of 90,260,000 tons of steel. That's a year-on-year increase of 36.2%. However, during the same period, the export value of Chinese steel amounted to $84.5 billion, which is a decrease of 8.3% year-on-year. According to overseas media reports, data shows that from April to October last year, China was India's largest exporter of finished steel products. China exported 1.1 million tons of alloys to India during this year, a year-on-year increase of 47.3%. China mainly exports cold-rolled coils, or sheets, to India, followed by hot-rolled coils, plates, pipes, and more. According to the Association of Thai Steel Industries, the total import volume of Chinese steel products reached 3.5 million tons from January to September last year. That's an increase of 23% compared to the same period 2 years ago. Milcon Steel, a leading steel manufacturer in Thailand, stated that due to the influx of Chinese steel products, local production capacity in Thailand is likely to decline in the future. The China Iron and Steel Association stated that due to the expansion of export scale, 6 trade remedy investigations against Chinese steel products have been initiated by 5 countries worldwide in 2023. At the end of 2023, Mexico announced an import tariff of nearly 80% on certain Chinese steel products. Excess steel capacity in China is a major reason why steel traders are facing difficulties. According to Chinese media reports, many steel traders in China have frequently faced financial collapse. Many companies are facing bankruptcy, compulsory liquidation, and missing business owners. After the Chinese New Year, Yulin Steel Trading Company and Bao'an Trading Company in Sichuan Province have both gone bankrupt. Insiders revealed that before the Chinese New Year, Baotou City's Yulin Steel Trading Company pre-collected customer payments for rebar under the excuse of ordering winter storage resources. But the company did not place orders with steel mills. Instead, they kept all the proceeds for themselves. As a result, they were unable to deliver goods. The involved funds amounted to 100 million yuan, equivalent to around $13.8 million, and now they've run away. According to Chinese company information website Tianyancha, Baotou City's steel trading company was established in 2020 as a primarily wholesale enterprise. It has a registered capital of 5 million yuan, which is approximately $692,000, and a paid-up capital of 1.6 million yuan. This amount is significantly lower than the involved funds of 100 million yuan. The so-called winter storage of steel refers to steel traders stockpiling steel resources in large quantities at relatively low prices during the winter season, while they wait for prices to rise after the new year to gain certain profits. It is a similar situation for Sichuan Province's Bao'an Trading Company. Bao'an raised funds before the new year to reserve approximately 10,000 tons of rebar. Under the guise of winter storage policies, they pre-collected tens of thousands of tons of rebar payments. Most of the payments were a 20% deposit, with a small portion being full payment. However, the pre-collected portion did not result in orders placed with steel mills, leading to the inability to deliver goods. In addition to the bankruptcy of the 2 steel trading companies mentioned, Tianjin and Fujian are also experienced steel trading company bankruptcies. In early March, The Association of Metal Material Trade in Wuhan also issued a risk warning letter. It stated that after the new year, steel trading company bankruptcy incidents occurred again in Chengdu, Baotou, and other places. Some companies were defrauded tens of millions of yuan. Such bankruptcy incidents occur every year. According to the risk warning letter issued by the Association of Metal Material Trade in Wuhan, since August last year, bankruptcy incidents have occurred successively in Sichuan, Jiangsu, Zhejiang, Guizhou, and other provinces. Industry associations in the chambers of commerce in many places have issued risk warning letters, reminding steel trading companies to be vigilant against risk and avoid blind trading. In addition to the bankruptcy phenomenon, a large number of steel trading companies have undergone compulsory liquidation, and some business owners have even gone missing. According to announcements from the National Enterprise Bankruptcy Information Disclosure Platform, bankrupt companies include Wuxi Bayan Steel Trading Company Limited and Wuxi Guangning Steel Trading Company Limited. In addition, Nantong Changyi Steel Trading Company Limited, Nantong Junyek Steel Trading Company Limited, and other steel trading companies have been ruled bankrupt by the court. Some steel trading companies are undergoing compulsory liquidation, such as Sichuan Jingchuan Steel Trading Company and Wuxicheng Youxin Steel Trading Company Limited. In addition, some steel trading companies have gone missing during the bankruptcy liquidation process, with Nanjing Wuqiang Steel Trading Company Limited being one of them. Numerous industry insiders noted that this pattern of downturns has persisted since the previous year, with such occurrences being almost annual. However, the market outlook for this year is notably worse. In the industry's view, the underlying problems are related to various factors, such as China's economic transformation, economic downturn, weak downstream demand, excess capacity, and transformation of the steel trading industry's business model. Given these circumstances, the viability of steel trading companies is a cause for concern. A senior executive of a large steel trading company said that from the current perspective, it is indeed more difficult to do business this year than in previous years. The overall demand is not as expected. Since the second half of last year, there have been few new real estate projects. Many infrastructure projects have been delayed or cancelled. The fragility of the real estate and infrastructure sectors indirectly influence the construction machinery industry. The executive said, the ideal situation for the steel trading industry is when supply and demand are both strong, prices rise slightly, or when there are fluctuations with both ups and downs. Currently, this unilateral downturn makes it difficult for any steel trading company to survive. Chinese Steel Plate and Strip chief analyst Cao Jianyong found that the profitability of steel companies in 2023 was poor. In 2019, the profits of various steel varieties have continued to decline. The average profit of rebar, hot-rolled, medium plate, and billet has been at a low level for nearly 5 years. Profit in 2024 remains weak. Since the beginning of this year, steel prices have been falling. According to data from China Steel Network, from the beginning of this year to March 20th, the Shanghai Rebar Index has dropped nearly 4,000 yuan per ton to 3,544 yuan per ton, a decrease of 419 yuan per ton. This is roughly equal to $59. In the futures market, the price of the main rebar futures contract has dropped from 4,047 yuan per ton at the close of January 2nd to 3,570 yuan per ton on March 20th. In addition to steel, products from China's new 3 exports are also pouring into foreign markets due to excess capacity, thus intensifying the trade tensions between the CCP and the West. The CCP authorities have openly stated that they will focus on exporting more Chinese new 3 products, namely electric vehicles, lithium-ion batteries, and solar panels. Foreign experts who have long been following China's issues have warned that China's excess capacity may lead to other countries implementing stricter countermeasures. It will result in confrontation that both the Chinese economy and the global trade system cannot afford. U.S. Secretary of the Treasury Janet Yellen visited the Suniva solar cell manufacturing plant in Georgia on March 27th. She said that China's excess capacity distorts global prices and hurts American firms and workers, as well as those around the world. Due to the influx of cheap imports from China, the plant was forced to shut down in 2017 and recently reopened. Janet Yellen stated that while the Biden administration is investing in America, it is also closely monitoring pressures from abroad that pose risks not only to the United States but also to the global economy, thus aiming to protect American industries from unfair competitions as much as possible. She mentioned that in the past, support from the Chinese government in industries like steel and aluminum led to excessive investments and overcapacity. Chinese companies aim to export their products abroad at lower prices. This sustains production and employment in China, but forces industries in other parts of the world to shrink. Now we see overcapacity in emerging industries such as solar energy, electric vehicles, and lithium-ion batteries. Yellen stated that the U.S. had previously raised the issue of overcapacity with China during discussions. She plans to address this issue as a key topic during her upcoming visits to China. According to Bloomberg, Yellen plans to visit China in April. This will be her second visit since taking office. It will also be the first official U.S. cabinet visit after the Biden-Xi meeting in November last year in San Francisco. Undersecretary of the U.S. Treasury for Internal Affairs, Jay Schaumburg, said in February that the Biden administration is concerned about the measures taken by Beijing to revitalize the slow Chinese economy. These measures could lead to a surge in low-priced exports, thereby destabilizing global markets. The crisis in China's real estate industry has hindered economic growth, prompting the CCP to prioritize manufacturing, especially in emerging industries such as electric vehicles, batteries, renewable energy, and advanced technologies such as semiconductor production. In addition to U.S. concerns about China's policies, the EU plans to impose additional tariffs on Chinese-made electric vehicles. The reason is that new evidence suggests that the Beijing government is providing illegal financial support to this industry. In February, a business survey released by the American Chamber of Commerce in China showed that China's desire to digest excess capacity through low-priced exports is causing concern in other countries. China's export business is deeply involved, with 70% of major export commodities being sold at reduced prices over the past year. Analysts say that China's crude steel production accounts for 50% of the global total. Its automobile production exceeds 30% globally, so the aggressive low-price export strategy could worsen the global market situation. A political commentator based in the United States, Chang Jingyuan, stated that the CCP's consistent strategy to support dumping of low-priced goods overseas with massive subsidies allows China to dominate markets, forming a monopolistic dependence, thus providing the CCP with more political leverage and greater economic benefits. China's overcapacity and massive dumping of low-priced goods overseas, especially of new energy vehicles, have raised significant concerns and attention internationally. On February 20th, the South Korean Ministry of Environment finalized reforms to electric vehicles purchases subsidies for 2024. The most significant feature of this reform is that it provides more subsidies for high-performance electric vehicles. It considers battery efficiency and recycling value as the main criteria for subsidy payments. A new plan significantly reduces subsidies for vehicles using lithium-ion phosphate batteries manufactured in China. Subsidies for electric vehicles using these batteries are reduced by up to 40%. Meanwhile, electric vehicles and large passenger cars equipped with relatively high-performance batteries made in South Korea will receive higher subsidies. The South Korean market is increasingly dominated by the Chinese battery and electric vehicle companies. Last year, electric buses manufactured in China accounted for 54% of sales in the South Korean market, totaling 1,522 vehicles. Electric trucks also accounted for about 20% of the South Korean market share. 96% of South Korea's exported electric vehicle batteries come from China. Some industry insiders believe that South Korea's new subsidy policy aligns with foreign policies like the U.S. Inflation Reduction Act, IRA. These policies potentially disadvantage Chinese battery companies to some extent. Previously, the IRA provided up to $7,500 in subsidies for purchasing electric vehicles. However, crucial minerals in electric vehicle batteries must be sourced, processed, or recycled from the United States or countries that the U.S. has a free trade agreement with. Moreover, electric cars and batteries must be assembled in North America to qualify for subsidies. Tesla CEO Elon Musk said that if there are no trade barriers established, Chinese car companies will pretty much demolish most other car companies in the world. Last year, Tesla had to reduce prices to compete with rivals, but Musk noted that existing products had reached the natural limit of cost reductions. Not only is the United States attempting to exclude Chinese electric vehicle companies, Europe is also strengthening trade barriers. In January of this year, the French government implemented an incentive measure for electric vehicles. Under the new subsidy rules, each vehicle will be assessed for its carbon footprint based on factors such as materials used, battery type, and place of origin. As a result, inexpensive Chinese vehicles are excluded, and many European and American brands may be affected due to the use of Chinese batteries. Undersecretary of the U.S. Treasury for International Affairs, Jay Schambach, told the media in February that he visited China on February 5th to 6th. During his visit, he emphasized to the Chinese side that concerns about China's excess capacity impacting the global market are not only held by the United States. If China continues to export excess capacity internationally, the United States and its allies will take action. Tang Jingyuan believes that if the United States takes such actions, the world will accelerate its economic decoupling from China this year. The root cause of the trade war lies with the CCP, which opposes universal values. It is leading to the CCP's isolation from the free world and sharp economic decline. The CCP's proposal of internal circulation is actually a self-deception after being abandoned by foreign capital. Internal circulation is a Chinese government strategy to revitalize the economy by prioritizing domestic consumption over international trade. China's efforts to sell goods overseas to alleviate excess capacity pressure have already demonstrated the failure of internal circulation. Yet, the external markets needed by the Chinese economy are being sacrificed by the CCP authorities.